everyone. Thanks for coming. So today we'll be joined by Jill Banner from iPlan Group to discuss self-directed IRAs. Andrew Zyro, he's on Zoom, and he's from JMJ Capital to discuss hard money. Then we have Don Drecke from Cross Country Mortgage to discuss cross-country mortgage options for investor clients, and Wendy and David Dixon, who will be sharing about private money.
Hi, everybody. My name is David Dixon. My wife, Wendy, is in this chair, but she's in the car right now driving back and forth with three nieces and their sisters. I'd rather be here because the conversation's going on. So, just want to quick background so you understand who I am. Wendy and I have been flipping houses since 2012. We've had about 100. Not a big company per se, but big enough to have a lot of experience, most of which is years. And I'm more than happy to share that. If anything comes up that you want to dive into a lot of detail, some of our experience, we're an open book, and I'm happy to share all of it. But I don't want to take away from the discussion focus. So, we are still flipping houses, and we've gotten into commercial multifamily properties. Last year we bought 3 buildings totaling 177 units, and that really comes from the funding side of it. That's a banking component, and also private capital. So, I know that's funding is a big focus of today's discussion. So that's one thing that I can certainly speak out from our experience on the private capital side. And with that, for us on the flips, the private capital, the private lenders are basically the bank. And for those, once we get a property under contract, we go out to our private lenders, and I can get in, find the state. And we introduce them to the property. We get the financial projections, and they have the option of funding the project. In that case, they are the bank. They get a note. They get a mortgage. That is viable. We don't do monthly interest payments, which you can't structure it that way. We do balloon payments at the end, so that the property sells, they get paid first, and anything that's left over, then we get. And the reason why earlier I had mentioned something good and bad, there are times in 2018, 2019, we got our butts kicked. A couple reasons. One, the biggest thing, which I wanted to introduce something, is we call properties too long. It took too long to get them done. And when you're paying double digits, the other side of it is the contractor. If you don't have quality contractors, good relationships, that can bug them. But again, we can get into details on one basis. Moving forward for her and I, our focus is as we taper down flips, because that we're offsetting that with the ramp up of large properties. That is our long-term strategy. Don't hesitate to ask any questions about that. When it comes to some of the other information, I guess it's kind of a question for you guys. Goals, objectives, and what direction can we kind of give some information? Yeah, please. Yeah, so the flip business, excellent question. So there's a parent trust that basically oversees everything, and then we keep our viable products separate. Those each have their individual entities. And then our flips are all in one. It is an escrow, so it's passed through. Anybody else? No. So when it comes to the private side of things, so those you know, for us, I'm 51, so when we started, I was 40. At that point, already had friends that had transitioned from one job to the other. I personally transitioned all my money over to Joe's company, and we do send a lot of as much as we can people per way. So for that, it was friends that had changed jobs. We have one personal friend, his house is paid off. He takes an equity line against his house that was years ago was paying 3 or 4%. That we were paying 12. So it's free money.
So I would like maybe all part of the
Okay.
now.
Okay.
We bring the problem in, but I want to be and really
Yeah, so yeah, there's a couple things here. So obviously hard money lending, which certainly puts that as an option because, and I wouldn't want to necessarily hard money. You know, we one time we did. Now the big thing there is you want to turn down an opportunity because of the cost of capital. So in that case, it's 100% of nothing, or maybe premium capital to have the opportunity to continue and grow. If they do that, that gives you more traction with people around you to say, hey, here's what I do. So, marketing, at the end of the day, it all comes down to marketing. How do you go out there and expand social media, establish your brand, which we do. We're hosting an event here in this room in a couple of weeks to find more capital ourselves. On the larger buildings, on the private stuff, on the residential, $2 million, which is kind of how we get it several years. That gets chewed up in a little bit on bigger properties. It's important. That's the importance of scale. And it really comes down to managing yourself and tapping into friends. Don't be shy to ask you, especially with uncertainty in the market, where there's capital, where the risk can be. There's a lot less risk in investing in real estate.
Local investor groups, they'll have people come to those investment seminars or they want to turn that are looking to fund it, buying houses. Find some local investment groups.
Yeah, there's Facebook groups out there. I just joined another one this morning. You know, because it has become a platform. We have a syndication portal, properties, and on that it has a network.
Sorry guys, are you able to just speak kind of loud? It's hard to hear on Zoom, so with fans, and even in the back of the room.
Okay.
We all just feel it.
Yep, no problem.
You're outside, like, inside.
You're buying those. Can you do that? Want it to be for everything or do you do it for building? House,
Yeah, those are per building. There is a dedicated LLC for representation in the building. Our equity share is separate. Yeah.
So give more partners one LLC for that property, and then you guys have your own LLC that feeds into that, or off of that.
Yeah, for the legal, the banking.
So David went his LLC 25% of it.
Correct. Yeah, and then the big difference with the commercial buildings versus the residential buildings. On the residential properties, our investors get an interest payment only. On the commercial properties, they get an interest plus an equity share in the ownership LLC. So that kind of sweetens the pot a little bit. And the goal with those type of properties, we buy them, stabilize them through the renovation work, just like refi them with a lender, cash everybody's account, which then pays back all the principal, while then at that point their equity kicks in, and they own equity in the building in perpetuity. So essentially, they're referred to as Class B LPs in the ownership entity. So, and then when it comes to the different sources of funding for people, we have cash, and again, we have cash investors, we have IRA investors, which show a heck of a lot more intellect and detail than I can. We have, as mentioned earlier, we have a couple investors taking equity against houses. We have a couple investors, about half dozen, that have trusts that they use. And or we have people that use the brokerage accounts instead of actually taking the brokerage money out and lending, they will actually take a loan against the brokerage account. Same thing, it's kind of like taking an equity loan. So we do that where they have to pay, but we're paying higher returns than they get investments. With excellent question. So forgive me, I should clarify a little bit more. So an investment portfolio, if they have a fidelity.
There's a, you have a 401k somewhere for 50% up to $50,000. IRA.
Yeah, so with the biggest, I would say the bulk of our investors, and I think I would probably speak on the national average per se, but is through the IRA, just because of the power and strength that it can do. So with that being said, Jill Banner, their building is in Westlake, and they're fantastic. So I would promote Jill's company just because, even though there's another company invested in it, because we've had experience in both, and on a personal level, the hands-on, the timeliness of responses, the ease of working with them, I would say, Jill's company.
I would agree with that.
So I plan as a self-directed IRA administrator. We help your IRA or borrow from someone. So the way it works is borrow to you would open an account with us. You would fill out an application. You open the account with the same. Pull the funds over. After there, you find a copy directly to IRA. Investment obligation. Think of your IRA as a separate. You won't do anything without permission, right? Hey, I want to buy, 1, 2, 3 Street, those Friday, this is with get self insurance. You don't go close. Close on the app. That's important. When you're buying the car, you can try to review IRA and find something. Property is purchased, you don't want personal funds with your insurance. Tell us what they would pay. Give us IRA, so to us, online access, like 24 hours, you can receive $1,200 on one. Or we get to sell. Which tell us when it's we'll find a buyer, we'll put it or we'll not sell it. there's a couple little things that you warn about. There are prohibited parties and prohibited transactions. A prohibited party is your spouse, your legal husband, and parents and children. Okay. What that means is you can't buy a property with a child. You can't buy a property with a child. You can't buy a property and a spouse. You can't even buy a friend vacation property. But you can, your brother, cousin, stepchild, unrelated third party. That means it's buy a property like this. The other thing that means is you can borrow from your cousin, brother, sister, spouse.
Is this a different specialization, something maybe the guy I have my money with and that our IRA does? Is this something
Yeah,
he probably doesn't?
right. Most likely, whoever you have, whether it's TV or Delphi, if they're pushing a button about the stock market, mutual fund, or risk, they're giving you financial advice. Self-directed is truly self-directed. It's besides last month. So things that require a lot of paperwork, they're not going to be able to do a custodian for it with someone like us. Think of us as potential
This is self-directed.
self-directed when you're doing alternative, we call it alternative assets. So things besides. This is a third of our clients. Another third will belong to folks. So it's identifying those people. And also, let's say you identify, you've got a, boy, she wants to invest in self-directed IRA expert. Call that a strategy session. We are super fast. I wasn't planning of that order again. Built by investors. So we do very fast. I don't know how much burn, but that means we actually. That's a little. Some people might, like, I don't know. I can't give my friends. But I love to talk about my, I do just a lot of listening. That was a lot of, and it's toilets, trailers, trash, turnover, and turn.
All fun stuff.
So now I don't get the call, I just get to check it. Take a picture from it. So much easier. I do. Still on some minutes. And plus, if the market takes a turn, like, make as much as you want. As well. One thing I like to do when I'm looking at it, I'll make sure that, well, I was ready to make sure that I look at the transaction. There's a property, I make sure I'm in the first position. Property transaction. I get the, so I'm doing all of these things. Sure that when I loan them, our loans are supposed to.
Yeah, and that brings up an excellent one of the points brought up there, the active versus passive. That's a decision that everybody needs to make. So, you know, you want to be in the grind, you want to just everybody. That's a key. Have the time and energy resources to handle the execution of renovating, whether it's residential. You know, certainly a fantastic alternative to passively. I know for Wendy and I, not that I'm here for someone else, but you know, we have a goal set from now to the end of the year to raise an additional 500 an additional $5 million to execute our portion of those. So, there's always an opportunity to get involved in that. Keep that in mind. So,
You guys have a minimum professional leadership by different levels.
yeah, for us, it's 50,000 as our number. From an accounting perspective, and there are also limitations. We do 506B syndications. We haven't done C yet, but with those, you're limited, I think, 30, like 35 investors that you can actually bring per transit per deal. So, and then I think, I don't know. Yeah. So one thing to keep in mind, and again, as mentioned earlier, when it comes to companies like Candy's, even though the cost of capital might be a little respectfully, there certainly is. It's a vehicle that can help scale and grow. Sure. So, Andy, if you want to chime in and kind of chat a little bit about what you do.
Guys, I'm having real audio problems. I don't think anybody's monitoring the chat. I can hear David off and on, but I can hardly hear anybody else, not anybody from the audience. Can you hear me? Can you give me a thumbs up if you can hear me really well? Maybe somebody can come close and repeat the question, and then I can answer the question. Maybe closer to the audio source. Okay.
I think it's, yeah, I think it's just a fan that's basically, yeah.
So Andy, if you could just kind of talk about definitions of hard money,
Sure.
a little bit more about specifically about your company, what you're doing, types of products you lend to, sourcing,
Okay.
and go.
Broad overview. Okay. I did hear David best of all in the first part, which is good. So maybe to piggyback off of that, he was using the term private money. Most people in the industry on your side, investors, know us as hard money. We actually like the term private money better, but we can use them interchangeably. Essentially, hard money is private, institutional private money, right? So it's kind of a hybrid between the banks and your neighbor, a family member, somebody that's going to lend you the money directly. Okay, so we do use best practices for banks and other institutional lending, but it makes sense lending too, and it's definitely asset based. Generally, no borrower debt to income ratio. We don't take tax returns. We don't take bank statements. I'm sorry, we don't take pay stubs or any income. So we're just going to generally underwrite your ability, and then we're going to underwrite the asset. So again, it's much easier money to get. It's what led me into the business. So I started off where David was, and where you are. I was an investor myself. I actually met David years ago through networking, investor events. And I took, private money, hard money myself. I was flipping and doing some other projects. I started working with a Cleveland company called Freeland, Josh Cantwell, which introduced me to being a lender myself. And then I also helped raise private capital for their fund, and doing what, again, David is doing, buying apartment buildings, doing syndications and equity share there. So I saw a lot of the pieces of different kind of things in that space. COVID shut them down as a lender. I liked what I did. I was having some success at it. So I decided to go out and be a broker. So what I do is I broker private money, institutional private money or hard money. I work with upwards of 40 to 50 lenders, both small and large, nationwide. I don't have any restrictions. My business has grown from being almost exclusively localized in the Cleveland, Ohio area to now having national referral partners. So I do work in multiple states. However, Cleveland is still my backyard. It's still where I do most of my lending, where I'm most familiar with values, neighborhoods, quality of houses, different opportunities, etc. So I'm familiar with Cleveland as an investor myself, and as a lender more than any other area. That has also led me to find specific financing for our area, because we are not a New York or a Phoenix or a Miami. We're Cleveland, Ohio, and we don't meet a lot of the national lenders' minimums. So I've been forced to find the specific financing that will do some of our really good, let's face it, really great cash flowing investor properties. So that's my specialty. I think it gives me an edge because, sure, you could go to any one specific lender, even an area lender, you're going to get their specific terms. However, it might not apply to your specific situation, whether that's you as a borrower or the asset. So some of the many things that can qualify a deal could be, not meeting minimum purchase price, minimum borrower experience requirements, minimum credit, minimum reserves and cash ability to do it. From the asset, it could be, square footage, type of asset, and the list goes on and on and on. I'm not going to bore you with all those details. What a broker like me does is I regularly keep up to date with all the rapidly changing lender requirements and market conditions to stay on top of who's doing what and what's going to be the best loan for you on the specific property you're looking to finance. And let me tell you, it is a rapidly changing landscape on a regular basis. Last year was especially rocky. I don't have to tell you why. But we went through a really rapid kind of changes, and it forced us to constantly reevaluate and have backup options. And in some cases, we had to take a loan to option B, C, or even D to get it closed because things were moving so quickly. And what was true in getting the loan closed today, 2 weeks later, changed, and we had to adapt to that and have something in our back pocket to serve you and not say, sorry, we can't do it anymore. I do get calls on a regular basis of investors saying, hey, I had a loan, we were about to close, and such a requirement changed, and they said they can't do it anymore. They didn't have a backup option. So I think that's important, is we're with you from start to finish, no matter what. And so let's see where to go from there. I do all types of investor properties. I do no owner occupied properties, so I'm not competing with any of the bank mortgage lenders out there. Totally different space. I'm solely focused on investors. It makes me really laser focused and committed to you as an investor. Let's see.
Product type,
Yeah, so we'll do interest only bridge loans. So typically acquisition and rehab, or a fix and flip loan is how it's known. That loan is going to be interest only. Leverage depends on usually skin in the deal or down payment. How much do you have invested in it, and experience. Very little credit driven for this loan, okay? Because what does that really show? Experience shows if you've flipped or rehabbed before and done it, successfully. That's probably the biggest indicator on success on a project. Of course, being successful a few times doesn't mean the next project won't present a challenge, but usually the first one or the first couple or few are the most challenging. You learn a lot when you get into it. And so leverage and experience are what adjusts the loan parameters. We'll generally go up to 85 to 90% of the purchase. We'll lend 100% of the rehab, up to 70% of the ARV. That's kind of the golden rule or the formula to follow. Again, I have a wide range of adjusters where we actually can strategize and say, what's most important to you, the cheapest loan or the highest leverage loan? If you only have enough money to barely qualify and get the loan done, you're going to want the highest leverage loan, the least cash to close. If you're a little bit more experienced, you got cash to play with, you might want to say, hey, I want the cheapest option here. Okay. And so that's kind of we're going to tailor it to you specifically. Generally, you're going to need to show the cash to close, the loan closing cost points, which is origination that kind of pays the loan, your processing and appraisal, title, taxes, insurance. Most lenders will want to see some reserves. Do you have enough money to start the rehab? Because it goes on a draw process. You do some work, you get funds out of escrow and back in your pocket. You complete another phase, you get money back. That's the process, okay? They don't, as an institutional hard money lender, private money lender, we won't give you all the money up front. You may find some local people that'll do that, but typically any institutional lender is gonna want to only release funds for work completed. So that's kind of how the process works. For the long-term loans, I do rental purchases on a 30-year loan, rental refinances, same, PITI, principal and interest, taxes and insurance, amortized loan. We'll do portfolios, and I do some small balance commercial, some small multifamily. My range that I'm good at tends to be about 5 to 20 units, and that's usually more on the acquisition side. As it gets bigger, you might be better served by going to a local bank on a commercial property to get the long-term permanent financing. But on a value add acquisition and rehab or repositioning loan, I'm a great resource. Okay, I do a lot of those in the area, from real small 5-unit buildings, which are very, very tricky to do. If anybody has tried to go to a local bank on a small 5-6 unit in Cleveland, you know what I'm talking about. We can get to those loans done pretty easily, and also get you out of them fairly easily. So that's kind of what I do. I will field requests for other property types, but office buildings, storage units, garages, restaurants, strip malls, it's really not my thing. Okay. So that's the type of lending that I do. I own properties myself. We personally in Cleveland do short-term and mid-term rentals. We're transitioning into more of a room rental, which I think is the next wave that's coming. I do know the short-term rental market very well. We've been doing it for 7 years. I have lending options for that. I've found those options that can do, boarding houses, that can do short-term rentals. Of course, there's qualifications, and I'll go over all those with you, but those options are available. So don't think that you're limited, because there are options out there. And we're closing loans. So I have experience with it.
Great, I appreciate it. Any questions for Andy?
Do you have any,
I didn't hear that.
Yeah, how many units? So, new construction, short-term rentals,
Thank you. Yes,
smaller multi-unit buildings.
sure. Generally on the bridge loans, the lender is not going to ask what the exit strategy is. They're really concerned about the property as is. So whether that's you're buying something as is and rehabbing it, that's what they're focused on. If it doesn't look like there is an exit for whatever reason, they're going to ask about that. But if it's a typical property, they're not concerned. That's your business to either sell it or refinance it. At that point, if you want to re-engage with them as a long-term lender, if they do that, and many of them do, then we approach it then. So for new construction, they're going to look at plans and not so much at use. If it's really small, if it's odd, if it's like residential assisted living, and maybe there's an elevator or, you know, different ramps and different room sizes and configurations, they might say, hey, what's going on here? And kind of ask, and do you have a plan for the refinance? Do you have financing lined up? But, you know, building for short-term or midterm, I'll tell you, we're looking at that ourselves. I do ground up construction. Just actually completed one in New York, of all places, outside of New York City. It was a $500,000 single home. That was actually 500 was the loan amount. The appraisal came in at about 835. Those are higher numbers for Cleveland, not necessarily for multifamily, but for a single family house. But yes, we can do it. Generally, the biggest hurdle for new construction is experience. So in new construction, it's not like a rehab loan where pretty much a newbie, your first time investor can get into something like that. They generally can't for new construction. The way around that is you bring in somebody as a sponsor and do 1 or 2 deals with them. Maybe you help with project management or the operating partner. Maybe you've got cash and can do it with somebody with experience, but you got to get kind of that one under your belts. I have some lenders that'll do with 1 experience. I don't know if I have anybody that'll let you do your first one. And so it kind of begs the question, well, how do you do your first one? You partner with a builder investor. So, you know, I see a lot of these fall apart because the investor doesn't take it that far to get it done. And I would just say, how bad do you want it? You know, give up a piece of the deal, give up half the deal to get your first one done. If you have a long-term vision and that's what it's needed to get you into the game and qualified, you know, do it that way. Anyway, it doesn't work much different than a rehab loan, except that obviously you're going to be dealing with a builder and not necessarily a GC or doing it yourself. Generally, you cannot do a new construction yourself. But, you know, when you get the plans and the permits and everything, hand them to the builder, it's pretty much hands off and the builder's going to run the project. That's what you're paying them for. In a way, it's less of a risk than a major gut rehab or a major rehab project. A lot of investors get in over their heads on something like that. But when you have an experienced, qualified builder, it's like a factory for them. You know, it's an assembly line. This is what they do. So we can consult on that and talk about, you know, those requirements, about how to buy the lot, how to get the loan for the construction. There's a lot of pieces to that I don't want to get into right now. It's a little complicated, but I'll take the time to discuss it with anybody. And maybe I'll just say that I'm really accessible. I have a calendar link for anybody that wants to schedule a call. I don't care if you're totally green and not ready to go yet. I will talk with you and get you up to speed and answer questions that you have. So you can either message me directly or you can go through my website and schedule a call.
Any other questions? Andy's on the call there.
Yeah.
Yes. Dollar bank is different. I've heard. You hear about that.
Sure. When you do property and use cash or whatever, we all have a partner. That partner doesn't help us with it. Share, and that's the IRS. When you do this item with an IRA at the end of the year, whether it's short-term contributions or long-term contributions. So every time you're doing one, out of the IRA, makes it kind of a snowball effect. So, you know, if I make 100,000, you make 100,000 on something, I already have 100,000 to play with. It's got to pay 25 to the IRS. So that's what I like about doing inside of the IRA. Now, also inside the IRA, so let's say you have an IRA, you can make a contribution and you can start. The IRA can also take on debt. A certain kind of debt. IRA can take. So you think it's your IRA, let's say you only have that down payment. Get a little, non-recourse loan. It's a little thing, it's a little nuance. But your IRA can take on. The other thing I wanted to mention is our loaning their IRA. When I'm loaning, I'm in my 50s, I'm not going to 65 or so. It's more patient money. If I'm loaning them cash, I can make 20 grand on the deal. I've already bought the jet skis in my head. I'm going to call, how's the deal going? What's going on? Are you on track? But if I let my IRA, it's more patient money. Sometimes it's your borrower experience for you.
Now, a pressure. We're on.
So when the IRA purchases property, the IRA is going to own the property value. It's in a tax deferred environment, and you'll never, IRA will never pay tax. If it's a traditional IRA, you will only pay taxes when you take a distribution at retirement, and that'll be taxable. You're doing it inside of a tax shelter.
All of that,
Yeah, yeah, I'm ready to put that right. It's not hard money, yeah.
Yeah, I did that personally. Rental property, Texas, right inside the IRA, and there was that left right. Paperwork.
paperwork. The loan is spent. City in there. Borrow.
So that's everything.
Yes.
Part.
Just pick up a bunch of capital and go through the deal. Now you can lend that out to an unrelated third party, or you can have that IRA that you just rolled over, purchase the property, do that deal inside.
That's what I was doing. I read Chase. Chase IRA out. I talked to mine. For real estate.
You make money.
All you think is term. So we just said, I can't tax wall, something. That's where you make money. Tax wall. But it was a really, really.
Yeah, it's a vehicle that allows you to take control of your investment portfolio. The biggest thing, not all of us have the knowledge, skill, and ability to watch the market on a daily basis, make sure that's been, and even those that do don't always get it right, obviously. So I did just what you're describing. I did about 10 years ago. I manufacturing sales for 20 years. That shut down. I transitioned everything self-driven. And then I switched from a traditional to a Roth, took the tax hit, so to speak, so that way the growth inside the Roth is tax-free. That's the value for sure. So,
This is essentially your side of investment. Residential mortgage or any lender bank for your traditional side. Down payment 15 to 25%. All things. You're going to have to qualify. You're going to have to traditional money. And non-traditional money. So called ESPR money. That's coverage. And basically, no income verification one. property has an $800 mortgage payment and $1,000 rent. $1,000 rent. That's what they call a 1.25 debt service coverage. That loan is approved. If you get $10 an hour, we'll document it. Schooling the property you're buying for rent versus. Well, that's a true no income verification. All we're doing is verifying the
I've never been to how many.
additional lending paying credit. You already have 10 for 10.
How many units?
For you,
4 units.
single family, multi. So that's the traditional creative side. Mine is
What's the rate on that?
have with good credit, stay good credit, 70, you're going to see rates for finance. Sounds like a lot of today's market.
Yeah, any questions, anything specific? Devin?
Update. For
So you're looking at, so in this scenario, you're looking at the model, so to speak, of your 24 unit and looking to purchase it, of the value add project.
yeah, it's $30,000. Square foot cash. They let you be, they receive 6 months. After the SDR loan, they come with a 1 to 3 year prepayment. You can't pay down more than 20% of the principal in the 6th year, or else you're going to get hit. Anywhere from 2 to 3.25%. Right. So you want to build it up.
Yeah, there's a different structure.
Something. Possible doing business immersively.
Yeah, generally speaking, on a building, 24 unit, on a project like that, if you're coming, doing well, 5% very reasonable accomplishment. Because there's a couple things that you have to deal with there. One is, obviously the contracting component, which you don't own it per se, it's not within your control, it's a third party. You know, you have scheduling issues there, and then the other part is existing leases. You know, because you can bump leases to encourage people to leave. But at the same point, you still have to respect the leases. So that can be a gating factor. And kind of touch on a little bit of the prepayments, the couple of large buildings. 2 5-year term. We kind of tag everything 42 month refi on the bigger building, something that's 80 to 100, maybe 100. That tagging. There's a couple of things you're trying to accomplish there. You're trying to stabilize and generally do 5% on building. But then you want to get a 1 or 2 organic companies. That operating income level that allows you to get the fund. So if you get equalized, you're going to let a couple. Yes. Yeah. Yeah, so I can, again, obviously, you need cash flow again to cover the operating expenses. So you don't want maximum. Generally, if the building historically runs at 94% occupancy, expect that to drop someday in that range. Reason being is that it's a natural thing that they fear change. They obviously recognize that you can work on a property, so they're going to bail because they know rent once they get. Yeah, yeah. So so you have to just be prepared. So when you do your underwriting, you have to look at what's a building in a cash flow that gives you. So sometimes you have to overborrow. So that's something that you when it comes to, I guess, to summarize or any other goals and objectives that you might have, or residential, what's the feel in terms of those that maybe aren't currently investing, buying property, to any of you that might be new that you're looking to get into? Are you looking to start in residential? This is a question. Is there anybody here that hasn't done a single investment property? Okay. So you're here for a reason. So what do you envision is the next, so this would be the little bit question, over the next 6 months, what do you envision? What would you like to do to get started? What do you personally do? Some of your goals? We were all.
I think what Andy said, if you can find a partner, give that partner 50%, whatever the number is off the top, to get you started, that's probably the best way to get started for now. Find that partner that's willing to invest in you and give him a tax spread off the top.
Yeah.
You get the fifth one, so you get the first.
Yeah, our first property, somebody stepped in, the deal sponsor, for financial reasons. So they want, banks on the larger buildings, they want 100% of the loan amount to be covered by net worth, and they want 10% liquid. So there has to be a financial coverage to make the bank happy. But the other part is the experience. So a friend of ours in the 11th hour actually stepped in and he picked up 10% equity because he had the experience. And again, it's walk before you can run. Put whatever cliche you want on it. But at the end of the day, we've got to build to your goals. You're not going to hit home runs right off the bat.
I've got a multifamily, I was told that's a possibly list, and I looked at the office, it's a real good opportunity for it. So I'm looking at potentially partnering with someone who's only 25% down, probably 100,000 purchase price. So I'm looking at 3 other partners having 25% stake with almost no cash out of pocket, essentially cost and commission baked into the sale. So we're hoping to have $200,000 purchase, my tenant moving out at 20,000 space of rents by $300, $400, $500 maybe refinance it or take some 50 other one. Any advice on direction to go there?
So there's a couple of things. One, it's making sure the partners that come into a project like that have complementary value. Somebody might take the lead. It depends on the different carve outs. We have an equity carve out for each value add portion of the project. Whether it's somebody that can take the lead on the construction side of it, somebody might take the lead on the banking side of it, making sure that when it comes to an entity that is formed, that the operating agreement spells out the roles and responsibilities. You don't have to get, you don't get real detailed, but it's the high level responsibility of each party. We certainly have attorneys and people that can take a look at that. I'm happy to share that info. Because at the end, even the underwriting, our underwriting model takes a few hours. I'm trying to make it more intuitive, but it takes some time to really dive in and understand. You shouldn't necessarily be speculating on what the rents are going to be. It is speculation, but you should have some predictability in terms of, based on the history of the
It's
market.
an area I know pretty well, so it's,
Yeah, and the general consensus is rents are going to jump. Again, I'm regurgitating predictions that in 2025 rents are going to jump because there aren't going to be as many new construction deliveries. Because any project that's going now has already been financed, that was locked in, so those are continuing. But stuff being put on the books now, it's very minimal what's happening. So then in 12 months, 18 months down the road, there aren't going to be nearly as many deliverables, so the supply and demand will be impacted by that. Yeah, but I'm happy, like, if you want to talk in more detail, happy to share. I'm an open book. I got nothing.
and what's say 200,000 purchase price, we're gonna have to get, 155 on that property, we wanna increase the value, say, we're appraised at 270, what can we take out of that? 77.
Up to 7 cash out on this.
So I'm going to go back to the previous question for people that haven't gotten in yet. Because again, everybody started something. We all have reservations. I still get nervous. There are times when, we all have self-doubt. We all have these things that come into play. So please, share thoughts, ideas, and don't be shy.
So I had started this. So my parents, they would know I was my home, it was when I started, like, every time. And then we started everything. I was playing.
Yeah, that's, it's great. So a couple things, we had, when we started, we had a gentleman that was Wendy's brokerage. She got her license with, ripped the Band-Aid off. That was the message that he gave us. You can analyze. I have friends and business associates that they spend more time educating instead of acting.
By the time they analyze it, I've already gone.
And again, I would share the same thing. If you want to talk, just talk.
Okay, so I call this your R&D department, your rip off and duplicate, creative.
Yeah, at the end of the day, and get a little choked up when I say this, but in any aspect of life, we're better off helping each other. So
I think we're in.
well, at the end of the day, it's a conversation. So
So when I asked about
I would just start with an LLC because there's two things that come into play. There's two things that come into play. You have to protect your own assets. And I ignorantly comes to taking an equity line against the house that you own. I don't know if you need to put that into an LLC first. That's beyond my control. I would definitely set up an LLC as an investment.
And if I can get the contact info, there's something called 3-day actually happening as we speak. Ask the lawyers, and they'll go over all this stuff, so there'll be fire ways, but get your contact info. And it'll go over all those tax records, but I agree with my just complex. Or holding company. Just later on as you get.
So for each home, do I need it different? That's it now. Property.
You can,
Yeah,
and obviously in the state of Ohio, it's $100 there. So you can. In our list, we don't. It's all for one. Some attorney might tell me. When it comes to whole properties, yes. Because again, that's asset protection, which, you're getting a freebie.
And I have to say, one word about it, it's not. Right. It helps have a tax. But the usually say, nothing else, you have to know it. You have a lot of equity in one house. So house is but we're in Ohio.
What about the bank? Yeah, that's separate.
And I'll give you one more tip. That can be a real big jack up the books that you.
Yeah, on a personal and professional level, it's a friend of mine, and he has a charity on the rainbow by the village. And, because he's an investor as well. Now, that's somebody that I've known for 30 years. It's Andrew's firm. They're pretty, he's a hustler, but he also spreads himself very thin. There are many different real estate focused CPAs. So I do have a couple others in mind, and again, happy to share. Contact them.
Right, she's really good.
That's good.
Put on the ratio, ROI. That's what she did.
No, there's a lot of.
Yeah.
She's a tax intern.
You email me, I'll reach, I have her. She's good. Yeah.
Well, they're all of their, they're kind of just other qualities. If you haven't signed it yet.
As far as, I was thinking on that, they're gonna take the data that you give them and plug it in. You have to educate yourself on what. Our meals and entertainment, our meals, that's 50%. That's, yes. Why have meals? Yes, but I cater them. So it's how I report it. But if I send it to them and say, oh, so you gotta educate yourself, and it's really there's really amazing. Can I share one more? So you guys are all gonna have meet coordinates. You're gonna have a board meeting in February. So, taking the board meeting So my children are part of. Get there by. Get off cruises. Cruises are not tax deductible, but transportation to and from a meeting is. So you go to train, a plane, a car, a bike. So my transportation and a meeting is tax deductible. Are you? Right, $4 an hour, don't be.
So you just saw her with the fact that
I told her, yeah.
I hear all these things. And
Yeah,
I'm
sure.
like,
Have children, pick your children. Still favorite children. They're not just children. Their own life. I'm using tax dollars. I pay her and then. Lots of tips.
that was fun.
Then you use your own money to, one more thing, there's, so we talked about IRAs and 401ks, there's something called covered education account. So my children have oil and gas, covered education account. So, real estate is paying for their college education. There's also something called a health savings account. Use your health savings account. It's more than just, but if we do it one-on-one. Yeah, HSA is a maintenance. Like a lot of. And I'm looking to, normally I do strategy sessions. Westlake. Oh, or we'll do it over the phone, it's fine.
I like being a person.
Oh. That's your. So, next. Having a roll call, let's get here. 33. And 5, so work this year. This house, we have 1 house. And we do nothing else. But you take a shot. It's just they're gonna go. You don't have to be dead on the man. Just walk by it, just trip up, figure out how to do it. First of all, so, yeah, I mean, it sounds, we will simplify it with the number of chips, okay? Good. So, yeah, so just think about, okay, we have able to say, go back to that. $3,700. Square foot. Good. Keep in mind, 3 houses, so 15 years.
Yeah. Thank you. I have an opinion on, there's a lot of people out there selling you education. And I think this is just my stage, because I'm a local home pursuit. It's a lot of research, so many moving parts, and so many different licensors. All right, that's not that. Oh. I appreciate it. Some people make that hard, and some people very, very profitable, there's just a lot of moving parts. I don't know, we have a.
Not much more than that. I don't have experience. Again, it's time and energy that you would have to put into something like that. Potential staff.
Not just now.
How we navigate. What's the brand of our triple my mom? I help them get part-time. So how do you find them? How do you start them? Run off. Yes, I don't even want to go in. I minimum work that I know that some project and we holding the house 4 hours. By me. So, I time practice. I kind of feel like I'm not. End up not working next time. Start all over. I'm here. Buy a house. Now about time.
I'll let you know when I figure it out.
Okay.
You know, to answer that, I can answer that in many different ways. If you ever talk to a real estate investor, that's never experienced that, they're lying. I say that with 100% certainty. So, we do contracts with construction companies into that are post work, you know, and I shared the story with some of them when they asked. My dad paid me one time to do something before I did it. Guess what? If the contractor needs money to show up, that's a dangerous place to put yourself because you're going to see other ethical behavior, which, and there's no real big brother. If you screw up in the corporate world, guess what? You get fired. If you screw up in the contractor world, it's like you shut your doors. That's $99. You know, it's an unfortunate thing. What I have learned the hard way is developing a relationship before we talk about it. I want to figure out if they're a good person. That's not an easy thing. There's no magic sauce there. I know that doesn't necessarily answer your question, but it's a paper trail that's important to establish.
You think that's fine for our own.
Yeah.
You think that's fine.
There's a daily kind of thing. So the one thing, and what you had mentioned about when it comes to acting as a GC yourself, that's what kicked our butt in 2017, 18, because I was acting as that we couldn't find GCs that would consistently perform. And what I lost was then that daily accounting component, because if the HVAC guy's not done, it affects the plumber, that affects the electrician. How do you handle that snowball effect? It's not the electrician's fault that he can't start on time. So that is a very slippery slope. So if I were acting as a GC, I would probably be more inclined to bring some people in house, and then use especially trades to do nuances.
Yeah, that's what
Of the work. So I would have a staff in house 75% of the job, if I were to go down that path. So it's paperwork and, lien waivers, we haven't signed, but I will also tell you that I didn't go with the price. I took downtown to file it because the attorney said file it, and I took it downtown to file it, and the woman said, I said, I'm filing this. So that doesn't stop it. It's the unfortunate part. So. Yeah, we have an independent contract agreement, it's 4 pages, that then has a million documents with it, which includes insurance indemnification form, because they have to carry their own insurance. There's also a payment schedule that has details on, to get this done, to get this money, and that's all signed up. Then we have a scope of work that I do for each project. And I'm still doing that because I can't do it. I like doing that. Well, yeah, and then lien waiver with every payment. But again, it doesn't stop. It doesn't. It just gives you a paper trail.
So like my last. A lot of people make. And I had found that was an entity, now I'm happy. I don't know how. I'm not kidding. If I know what it is. You must have made your hair start with it. And now, that's have a hard, like, don't have a hard time following it. Can't start without.
Yeah, in a scenario like that, again, to tell you that there's magic sauce, not going to risk on this. As that same person, well, what if I actually do 50% of this before I can be happy with that? Why would that be? Because at the end of the day, they have more leverage because they can put a lien on your property. Yes, you can bond it off if you go to sell it. There's 6 years to file with the process. They have expenses. If they cause the problem, all they do is shut down their LLC stuff. They are not collectible. Nothing. So.
I got to get going, everybody. I'm sorry. I got another scheduled meeting.
You're good.
Thank you for the invitation. Feel free to get in contact with me. Happy to help out anybody. Have a great day. Thank you so much.